stocks here are set to close out a strong 2024, but one strategist points to a few hurdles markets will have to clear to have the same success in the new year. For more, let's now welcome in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeff, always good to see you and have you on the show. I want to talk about the incoming Trump administration, Jeff. And, I think investors are trying to sort through that, taxes, deregulation, but it's really tariffs that I think are front and center right now for investors. And I'm curious, Jeff, as a market strategist, how are you thinking through that dynamic?
Well, they certainly do pose a risk to growth next year, but I think the bark is probably worse than the bite. If you take a look at every single tariff threat that President Trump has thrown out there, and we have tallied them up, you end up with a 26% import tariff on imports into the U.S. That's up from the 2.6% rate it is now. That's massive. It actually exceeds the Smoot-Hawley tariffs that preceded the Great Depression. But we think, the bark is worse than the bite. Maybe a 10% tariff as opposed to going all the way up to 26. And the IMF looked at that scenario in their latest World Economic Outlook. What would be an across-the-board 10% tariff and the impact on economic growth globally? Just 0.1% less. So I think that's something we can absorb and still see better economic growth outside the U.S.
You're not the only one everybody seems so confident that the full tariffs will not be put into place. Why is everyone so confident that that's the case? Is it because, there was some level of tariffs obviously put in during the first administration, but why does everybody seem to be drawing that conclusion?
I think there's three reasons. One, there were trade deals in the first administration as well. So while tariffs went into place, we had a phase one trade deal with China. We had the USMCA agreement with Canada and Mexico. We even had a free trade agreement with Japan and South Korea negotiated during the first Trump administration. Second, I think he's using tariffs not as economic policy, but as statecraft. Notably, what was announced last week with regard to Mexico, really trying to get the border shored up, less about actual tariffs. So I think it's a tool for statecraft rather than policy itself. And then finally, I look to other examples around the world. We've seen so many incumbent governments tossed out with right-leaning governments, more antagonistic toward trade. And a great example is what just happened in Europe and their imposition of a 45% tariff on Chinese electric vehicles. That was, we are in the process of unwinding that right now. It just went in place on October 28th, I believe, or the end. Yeah, not long ago. It won't last very long, I don't think. We're very close to seeing negotiators work out a way around that in favor of quotas or price limits. So I think there's a number of examples where we could see where we're probably not going to see the worst case scenario.
Well, one other reason, Jeff, too, is we did have analysts coming on, and here was their case. They thought that ultimately the policy will be more moderate, more orthodox in the rhetoric. And their reason was just because Trump's, for his own self-interest, for his own success, he's going to want to maintain some basic level of market and economic stability, particularly for a president who we know likes to use the stock market as his kind of record of how he's doing.
Bingo. Yeah, he's absolutely very much in tune to the stock market, more so than the average president. And the markets are very quick with their feedback around what's going on. You've seen that today with political travails in South Korea or in France as well, right, this week. There's a lot going on, and the market's giving a lot of feedback to policymakers.
So if you don't think tariffs are going to be that worst case scenario and be a risk for markets, what is then the biggest risk to markets then? Or what are some others that you're watching that could unfold a little bit more dangerously for the market?
Well, there's a few things. One thing, the market is really counting on rate cuts, not just from the Fed, but other central banks. The ECB priced in 6 rate cuts over the course of the next year. Yet inflation in the latest readings, almost everywhere you look, went up. And there are some signs that maybe inflation's maybe gone down as far as it's going to go. We might see a bounce here. So the risk that those cuts don't materialize with valuations in some ways predicated on that increase in liquidity, that's a risk. Geopolitics are a risk, evidenced by what's going on this week. And then finally, related to the Trump administration, deportations are a risk to labor costs in the U.S., but also to Mexico. Mexico gets 3.6% of its GDP from remittances from Mexican nationals in the U.S., sending it back to Mexico. So there's a number of different issues we need to keep a close eye on.